Our first interview tonight is with American Care Source Holdings, an owner and operator of urgent care facilities, rapidly expanding through both acquisitions and new facility build-outs. Note also the insider buying on this stock. Let's go to an interview with CEO Adam Winger. Adam, thanks for being with us today.
Yeah, I appreciate you having me.
It's our pleasure. Your company operates urgent care centers, and I want you to talk to us about your overall business strategy and where you're at today and where you hope to be in the future.
Absolutely. The urgent care market, approximately 12,000 urgent care centers across the country right now. It's an $18 billion industry, and our focus is really consolidating that landscape in the southeast and eastern parts of the country. We plan to grow both by acquiring profitable centers and developing de novo centers around our acquired sites. We've got 11 centers currently. We plan to get to 25 by the end of 2016.
What do the financial metrics look like? What is an average center in revenue, and what kind of profit margins do you have?
On a per site basis, we're looking at $1 million to $1.2 million of total revenue with 15 to 20% margins, roughly $250,000 to $300,000 of EBITDA per site.
Okay. What does the competition look like for you?
The competition in our marketplace we view as not quite as strenuous as in some of the other marketplaces, the Northeast and the West Coast. We think there's still a lot of opportunity for de novo growth, and there are also a lot of good acquisition opportunities for profitable, healthy, very well-run centers right now.
So just so I'm clear, you've got 11 centers now. You're projecting you'll have approximately 25 centers in 2016 this year through, and how much of that will be acquisitions versus starting your own?
We're looking at effectively 2/3 coming from new center developments and the other third coming from acquisitions. So that breaks out roughly to 10 for new sites and 4 to 5 in acquired sites.
What does it cost to start a new center?
For us, it costs in between $300,000 and $500,000, and that investment over 9 to 12 months will get us to cash flow break even. To acquire one, we're looking at roughly $1 million to $1.5 million in acquisition costs, and those we think we can increase the profitability of a quality site by furthering the marketing and advertising. This is very much a retail business that really we want to be top of mind for the consumers in our communities.
I want to talk a little bit about your management team. Unfortunately, 6 months ago, the CEO died. You stepped in. I want to talk about your background and some of your board members, like John Papa John, for example.
Absolutely. My background, I'm a CPA by trade. I also served as the company's general counsel. I worked through the first 3 acquisitions as an outside attorney, joined the company to really fuel the acquisition strategy. I was the VP of acquisitions and started as a company's general counsel. I moved over with the CPA background, I moved over to the interim CFO role and stepped in with the passing of our former CEO. It took over really last month in January of 2016. Our board, we have an exceptional board with just an infinite background of experience, led by our principal stockholder, John Papa John, who has a tremendous track record of growing small publicly traded companies and really having good, profitable liquid exits with 3 to 5 year holding periods. He has prior experience in the urgent care space, and he's really providing the guidance and the leadership from a capital markets perspective that the company really needs right now.
Well, I will note John Papa John was one of the founders of the first home health care companies, Caremark, which was sold for billions, and of course investors could have gotten in at a very early stage. Your company, you raised $7.5 million late 2015. Right now you're trading at a $6 million market cap. Begs the question, are you fairly valued today? And what is it doesn't seem to me that you are at $6 million, particularly on your revenue run rate. And I want you to talk to us about your 2016 revenue run rate and what you think the real value of this company is.
So 2015 revenue, we were approximately 30 million. And after the disposition of a legacy business in 2016, we're looking at roughly $20 million of revenue from our existing holdings. We think with our additional growth, we will approximate $30 million in revenue. But from the market cap perspective, I mean, $5 million to $6 million market cap for a company that's on a $20 million run rate at a minimum, we think it's severely undervalued.
Well, I don't think there's any question about that, and I do think the fact that your former CEO sort of left us unexpectedly, dying, was a shock to the market. You stepped in to sort of absorb that shock. What are the biggest challenges that you face in 2016?
Our core challenges really relate to our ability to continue to raise money. We've been successful raising capital in the past. We have really no indication that we're going to have any trouble with our ability to leverage people like John Papa John. But we have a great fundamental business strategy in expanding this portfolio of profitable centers that American consumers really have an everyday demand for. It's just, for us, it's about raising the money to continue to fuel the growth at the pace that management wants to.
So what is the essential value proposition today then for investors? I don't have any doubt that if you need capital, you can access capital. And John Papa John himself is worth $600 million. But what's the essential value proposition for investors today?
The value proposition is the entry point for us. We have a trajectory that shows, we think double-digit EBITDA, double-digit profit year over year, trading right now at a $5 million market cap. The value proposition is the arbitrage that's going to come over the next 18 months.
Makes a lot of sense to me, Adam. I want to thank you for being with us today. We look forward to working with you and getting you in front of institutions and family offices and retail brokers. I think you're going to find that you're going to get a very good reception out there in the capital markets.
Thank you, Dave.
Thanks for being with us. Now, to get more information on American CareSource Holdings, visit redchip.com. And while you're there, subscribe to our weekly newsletter. Join the RedChip Nation today. You'll get a plethora of stock ideas on emerging growth companies, interviews, research reports, industry news, and much, much more. It's all free, by the way.